Theo Trade. This is Don Kaufman. It's June 5th, 2019, and you are watching the Theo Trade evening video. Another day and another wild rally to the upside. Look at this. There is some follow through from yesterday's buy side activity. The S&Ps are just 3 minutes away from the cash close, up some 21 handles. What I intend to do in just the next few minutes and on this evening's video is display a couple of different aspects that really may make you think twice, okay, regarding, of course, the rally that we've effectively seen over the last, 24 hours, 2 trading sessions. And with that, let's get down to it. So one of the first things that I want to bring to your attention, I'm actually going to zoom out just a little bit here on the S&P futures, is that we tagged the 2811 gravity point. Now, for those of you that have been tuning in kind of day in and day out, on Monday night's video, and please go back, reference it. One of the last things that I said on Monday's video, get ready for the rally. All right, that we're going to rally. We started the rally, all right, on Monday. Get ready for the rally. Tuesday, we exploded to the upside. I have to tell you, we've even exceeded most of my upside, potential over here. But then we clipped right to, and I want to bring this to your attention. If you look at the intraday trade, most of the intraday trade has actually occurred both overnight and during today's trading session. It occurred right around our gravity point of 2811. Now that we've actually broken off to the upside, the big question mark over here is, do you come into the next gravity point, which is 2842? I don't think we're going to make it. And I'm actually going to show you why I don't think we're going to make it. First of all, there's a few descending votes out there. One of them happens to be none other than the Russell. The Russell, interestingly enough, after having a wicked upside day, the Russell is going to end up on this trading session massively unchanged. So there is dissent, if you will, inside of the force. The next thing I want to bring your attention to, okay, we'll come back to volatility here momentarily, but I want to spend some time on the SPX. And the line that you see across your screen, that line is none other than the upper edge of the expected move for this week. Let's actually go to a longer time frame chart, kind of zoom out on this. We're also going to take you into the SPX itself in terms of on a day-to-day basis. And what you're looking at, of course, these happen to be the Wednesday options. They're about to expire here in the next 45 seconds. Here are the Friday options. And one of the real standouts is that between now and Friday, they're only expecting about a $27 move. Nevertheless, that would bring us, that would actually bring us right back inside. Again, if we move to the downside, it'll bring us right back inside that expected move. So from a mathematical standpoint, purely a mathematical standpoint, if you look at this expected move, right, the higher probability is that we close inside the expected move. Now, I also want to highlight the fact that last week we closed outside of the expected move. I keep reiterating, there's the closing bell. I keep reiterating week in and week out, do not be running out to sell premium. You just can't sell premium in this mess. Look at this. Okay. Expanded through the expected move. Slight expansion through the expected move, right? Obviously, last week expanded through the expected move. And here we are again. Now, we're outside the expected move, but wait, you still have Thursday and Friday. The higher probability trade says that we close inside of the expected move. I always go with probabilities, okay? On the flip side over here, though, if we are outside this expected move, we can obviously explode higher. Right now, again, I would anticipate closing inside of it, again, strictly from a mathematic standpoint. So I wanted to cover a little bit about the SPX, but the SPX doesn't actually say, definitively that we're coming back in. What does kind of scream to me a little bit in this marketplace, outside of course, the Russell is flat, but again, with all due respect, the Russell had just a wicked move, right? The last 2 trading sessions, and here it's at its final resting place, which ironically is right around 1500. All right, what really stands out to me? First, I'll start with oil. Let me get started on oil. Anybody notice? Oil just continues to slide today. Now, the petroleum status report comes out, which is a weekly report, typically comes out on Wednesday. I say typically because last week was a 4-day trading week. Then it comes out on Thursday. But the oil report comes out today, and oil got absolutely rocked on that oil report. Rallied back up and faded back again, but oil's down another 3%. I think at this point in time, you got to start to think about the upper $40 a barrel oil. What's going on in oil, right? For me, I step back from this and I say, well, wait a second. Isn't oil supposed to perform really, really well in an incredibly weak dollar? Well, the last 2 trading sessions, in fact, the last 3 trading sessions, we've had an incredibly weak dollar. It bounced a little bit today, but you would think that a weaker dollar may actually have a positive impact on any commodity product. Obviously, it's had a decent impact to none other than gold. Gold has been kind of taking off to the upside. If you haven't seen this in the last couple of trading sessions, gold is up, again, about $5.40 today. But taking a look at the chart over the last just few trading sessions, that, people, is simply because of the dollar. It's inverse to the dollar. Oil, it's not really helping it. So oil kind of continues to slide to the downside. I read this based on the volume and everything in here, and I say, they're actually pricing in a global slowdown. Literally, like global GDP doesn't look so rosy when they're whacking oil this hard, this fast. So oil, okay, could actually tip us off as to whether the S&Ps are ripe to what? To short. Should we short the S&Ps right now? Should we actually sell into this rally? Well, oil, right? This is not exactly like an overnight take. I think oil is going to take some time to kind of play out before people realize, like, hey, I think they're pricing in a global slowdown. All right. That's kind of one of the perspectives. Obviously, couple that with the Russell, we're starting to get somewhere. The next thing I want to bring up, the bond market. The bond market. So the bond market did kind of cool off the last 2 days. It cooled off, minimally so. I mean, come on. The bond market, and I've talked about this at pretty much nauseum, this thing hasn't had like a downtick until the last 2 days, period. Hasn't had a downtick now since what? Oh, I don't know. Let's get crazy, because you're looking at like mid-April. I mean, what are you waiting for? It's 6 weeks of upticks, 2 downticks, and everybody's like, oh, the bonds, the interest rates are about to go back up. I don't think those interest rates are going back up, especially when, you had a fairly substantial move yesterday, but today, the bonds barely moved down. In fact, okay, the way I see it, the notes are actually closed higher today. So the notes closed higher today, which is, again, all right, this, what we term risk on, risk off. Hey, listen, okay, the notes are higher. That ain't good for the overall marketplace. So we're still in this kind of duck and cover. And that is, when I say duck and cover, that is capital is flowing into the bond market, okay, out of the S&Ps. We just kind of paused along the way over here. Okay. Nevertheless, it's nothing more than a pause. It looks like the bonds are going to continue and the notes are going to continue right straight up, which could actually be a sign for some sell-side activity to come back into the S&Ps. All right. So now we have the Russell. We've got oil that looks a little precarious. We definitely have the bonds that look precarious, right? What else you got? Oh, this one's going to be fun. You got to read a little deeper over here. I'll start with the VIX. The VIX backed off a little bit. All right. A minuscule amount, though. I mean, come on. The S&Ps are up 22 points. The VIX kind of listlessly fell. But what really bothers me are the volatility futures. Now, the volatility futures that I'm looking at right now, I'm no longer looking at the 14-day volatility futures. That's too short of a time frame. If you're going to look at the volatility futures, get serious about it. Go a little further out in time. You got to have a little meat on the bone, more than about 23 days remaining to expiration, those vol futures. And one of the things that really, really resonates with me, look at the volatility futures out here. By the way, when I say out here, this is where there's volume, right? Okay. You have the July volatility futures sitting at 1738, almost flat with the August, almost flat with the September. That means the volatility skew, okay, you'd think after 2 wicked days of rallying, the vol skew would be like, where ultimately short duration volatility is substantially lower, okay, than longer duration volatility, but it's not. It's not like that. It's kind of like this. I mean, it's almost a flat volatility skew, which actually tells me the volatility marketplace isn't buying that the S&P rally is real at this point. Now, don't get me wrong. It could get real. It could get real. We could actually, light it up and fly again to the upside. But right now, the volatility market is tipping you off that they're not looking at this and saying like, these S&Ps are going to sustain this rally. Listen, if there was one indication on the screen, I would just push it aside. But when you're looking at this marketplace, it just screams to me Sell the bounce. Sell the bounce. Step in slowly. Step in with defined risk. What kind of stuff should you use? I mean, for me, if you're a little unsure, a little unstable and coming in here and thinking about like wanting to sell the bounce, right? You don't have to get, too crazy, too chaotic. You want to put just a couple of dollars at risk, right? Go out 28, 38 days, somewhere in this neighborhood, right? Open up the July 3rd options. Why not just use like an in-out spread? Look, we're trading right now right around, 283. What's in and out spread? The 284, for instance, could actually buy the 284, sell the 282s for a 91-cent debit. This is just a very mild short position. I'm not telling you go out there and load the boat and start selling S&P futures. For those of you that have some experience, sure, go to town, get short if you can handle that risk. Those of you that can't necessarily, handle the risk, the only way to step in front of the freight train, this is the freight train, is to use a defined risk trade. A lot to think about on this evening's video, but I like it. This is where I like to be as a trader. I like to go out there, I like to sell bounces. I'm not telling you I'm going to be right overnight. Listen, we called the rally. Now we're calling for a fade on that rally. Stay tuned. Much more to come. Thanks, everybody, for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.